This presentation summarizes the key factors affecting the value of a currency in international trade. And these factors are summarized here. They include currency speculation, productivity level, denomination of international commodities, in this case in US dollars, interest rate levels, which the higher the level of interest rates, the greater would be the value of the currency. Other factors held constant. Domestic political conditions, central bank intervention, the most controversial here because this is how countries manipulate their currencies in international trade. If you want to sell more goods to other countries, you do things to weaken your currency, and you can do that by selling your currency to receive the other foreign currency. And so if Japan sells the Japanese yen to receive US dollars, it's going to force the Japanese yen to weaken as they sell it in the market, and the value of the dollar therefore to rise if that's the currency they're selling it for. And many countries that prefer free-floating currencies frown upon that, and that has been an argument that the US government has used to criticize China for suppressing the value of the Chinese currency called the yuan or renminbi. And then the key factor, in my opinion, that influences currency valuation is balance of payments, which if you sell less than you are buying from the countries, you're going to have a current account deficit. And I summarize that balance of payments are a function of two sets of accounts, current accounts and capital accounts. Current accounts, the most important aspect of it are the goods trade, which is the difference between how much you receive when you export and how much you pay for the things you import. In the case of capital account, it deals with financial transactions. But if you look at the goods trade between the United States and its three largest trading partners, Canada, China, and Mexico, you see that across the board we have a huge deficit. We have huge deficits, the largest of which is with China. Our total trade with China as of 2015 is about $600 billion, but about 80% of that is in favor of China. This represents our imports from China, and this is our little bitty exports to China. So it doesn't look pretty at all. From Mexico, it's the trade gap here is about 61 billion US dollars. So that too doesn't look pretty. Canada is a little bit more balanced, as you can see. However, we still have a trade deficit of over $15 billion as of 2015. And in fact, if you look across the board in terms of total trade in 2015, our total exports for that year is about $2.26 trillion, and total imports, as you see here, is about $2.76 trillion. So it really doesn't look good across the board. And I show how it is that this sad story started back in the early 80s, when, as you can see here, even though our exports have risen consistently over the years, our imports have risen faster, resulting in this red line that you see here, which is our current account balance. And because it plots below the zero line, the current account balance that you see here is a negative current account balance. So that's not good. And here I show, however, that between 2007, when the mortgage crisis began in the United States, and 2016, that actually the value of the dollar has strengthened against most major currencies, summarized right here. So you can see that these are exchange rates expressed in direct quotes, meaning how much we pay in US dollars for each of these currencies. And how much we pay in US dollars has dropped quite a bit from 2007 to 2016 by these rates that I show here, except for three currencies out there. Three key currencies would include the Japanese yen, Chinese yuan, and Swiss franc, which actually they went up in value between 2007 and 2016. Another thing I wanted you to know is how it is that a lot of people around the world, they tend to prefer the US currency in times of crisis. So we call this situation flight to safety, or flight to safe harbor, which is when there's a financial crisis globally, as in the case of the 2008 global financial crisis, the Great Recession that followed it, and the European debt crisis, you see how it is that the value of the dollar actually went up. So the dollar tends to strengthen in times of crisis. I guess you could conclude that that's because the faith that the global economy has in the stability of the US currency is quite high compared to virtually every other currency out there. And then I also wanted you to observe the striking negative correlation between the value of the dollar, the red line, and the value of crude oil. And between 95 and 2015, you find that the two series maintained a negative correlation coefficient of 0.81. And in fact, if you look at the correlation since after the Great Recession in 2010 up to 2016, you will find this negative correlation coefficient to actually get worse to about, well, to actually increase to about 0.9. Now, different reasons have been advanced as to why there is this inverse correlation between the dollar and the euro. A discussion of that is beyond the scope of this presentation, but you can look up stories on the internet. And then finally, this shows that when compared to real interest rates right here, that there is a positive correlation. The red line that you see here is real interest rates. The blue line is the US currency. And that's it.